Here's the problem with retirement advice. The loudest voices are usually the most misleading. You've heard it all before. Never touch your principal, just spend the dividends. You need millions saved. Always max out your 401k. They sound safe, but following them can actually make your retirement riskier. I've seen it over and over. People delay retirement, oversave, and underlive, all because they believed these so-called rules. That's why in this video, I'm breaking down the biggest retirement lies one by one. I'll show you why they're wrong and what the truth really is. I will also show you a 4-step retirement system that replaces them so you can finally retire with clarity and confidence. Let's break down lie number 1, which claims that you should never touch your principal and instead just live off the dividends. Look, on the surface, dividend investing sounds like the perfect solution. Buy high-yielding stocks, spend the dividends you receive, and you'll never have to sell any shares. But here's the problem. Those dividends are not free. When a company pays a dividend, its stock price usually drops by the same amount because a dividend is simply a distribution of company profits. It is not extra money in your pocket. In fact, when you receive a dividend, mathematically, your portfolio is in the same exact spot. And the risks pile up. The highest yielding stocks often have high yields for a reason. They're distressed, riskier companies trying to attract investors. That means that chasing dividend yields can often lead you into concentrated, low-quality investments. And even if you try to take a conservative approach, Charles Schwab reminds us that trying to eke out a reasonable living from dividends and bond income may necessitate dedicating a disproportionate share of your portfolio to fixed income, making the overall mix less diversified and riskier. And don't forget about the tax hit. Dividends outside of retirement accounts are taxed every single year, whether you spend them or not. Over time, research shows that dividend taxes can reduce investment returns by up to 1.5% per year. So what's the better approach? Total return investing. Instead of buying a stock or a fund just for its yield, you invest broadly in high-quality stocks and bonds, and then create income by strategically selling shares through different market environments. This way, you control the timing of taxes, diversify more effectively, and generate a steadier, more reliable paycheck. According to Vanguard, a total return approach can help to minimize portfolio risks and maintain portfolio longevity while still allowing an investor to meet their spending goals with a combination of portfolio income and capital. So instead of chasing dividends or clinging to the idea that you can never touch your principal, the smarter path is to use your whole portfolio, including cash, asset sales, and dividends to create reliable income in retirement. And that brings us to another dangerous belief, one that holds people back from retiring with confidence, which is this idea that you need a neat, round number like $1 million before you're allowed to retire. But here's the truth. That number is completely arbitrary. It's stuck because the famous researcher William Bengen used $1 million as a simple example when introducing the 4% rule. It was never meant as a universal target, yet decades later, we're still treating it like it's a scientific fact. And that's dangerous because retirement is not about hitting a magic balance. It's about whether your savings combined with Social Security, pensions, and other income can actually fund the life that you want. Think about it this way. 2 people can both have $1 million saved. One needs $30,000 per year from their portfolio. The other needs $130,000. The first person can retire comfortably with less than $1 million. The other might feel stretched even with $2 million in the bank. The account balance alone tells you nothing. And that's the trap. For some, the $1 million myth causes unnecessary fear. They see $500,000 or $700,000 saved, and they think that they've failed or they need to work longer, even though their lifestyle would be perfectly sustainable. For others, it creates an obsession. They push harder, sacrifice experiences, and they chase a number they may not even need, only to realize later that they've oversaved and underlived. I've seen both extremes. I've worked with couples who retired happily on $600,000 because their lifestyle was modest, expenses were predictable, and other income sources filled the gaps. And I've worked with people who've stashed away millions who felt anxious because their spending far outpaced their income. It's all relative, so stop chasing someone else's number. The only number that matters is the one tied to your life, your goals, and the income that you actually need. And that brings us to lie number 3, one that doesn't just distort how much you save, but where you save it. And nowhere is that confusion bigger than with your retirement accounts. The lie goes like this: if you're serious about retiring, you must max out your 401k or IRA every single year. At first, it sounds smart. After all, saving more is usually better. But blindly maximizing pre-tax contributions can backfire by creating massive tax problems later in retirement. Here's why. Every dollar in a traditional 401k or IRA is a future tax bill. Once you turn 73, the IRS forces required minimum distributions. If you've piled up millions, those withdrawals can be huge, often more than you need, and can push you into higher tax brackets, raise Medicare premiums, and increase the tax on your Social Security. That's why it's critical to remember, not all accounts are created equal. Roth contributions, for example, they grow tax-free and provide tax-free withdrawals in retirement. And don't overlook the plain vanilla taxable brokerage account. Save and invest in a low-cost, globally diversified ETF. And when you eventually sell shares to fund your retirement, most of your gains are taxed at the friendlier long-term capital gains tax rate, not ordinary income tax rates that hit every dollar you pull from a pre-tax retirement account. On top of that, your brokerage account gives you flexibility. You can tap the money anytime without age restrictions or early withdrawal penalties. The smart approach isn't maximum contributions, it's strategic contributions. For some, that means contributing just enough for the employer match. For others, it's splitting between traditional, Roth, and taxable accounts to create balance and flexibility in retirement. So don't fall for the myth that the IRS contribution limit is the target you must hit. The real target is whatever mix of saving strategies puts you in the best long-term position. By the way, if you need help with your retirement and tax planning, click the link below to schedule a free retirement strategy session. My team will review your exact situation and show you opportunities to lower taxes, maximize income, and improve your overall retirement plan. Okay, let's move on to lie number 4. This lie has kept more people stuck in jobs they hate than almost any other. Conventional wisdom says your retirement accounts are off limits until age 65, or at least 59 and a half, and that tapping them earlier triggers huge penalties. But here's the truth. Your money is not nearly as trapped as you've been led to believe. With the right strategies, you can access it years earlier without paying the 10% penalty. Take the rule of 55. Leave your job in or after the year you turn 55, and you can tap your current 401k penalty-free. That's a big deal for early retirees and a reason you might want to hit the pause button before you roll your 401k into an IRA. Now, what if you want to retire even earlier? That's where Rule 72T comes in. Say you're 50, ready to leave work, and you've saved $1 million in an IRA. Under 72T, you could set up fixed annual withdrawals, say $40,000 per year, that avoid the 10% penalty. But here's the catch. Once you start, you must continue for at least 5 years or until age 59 and a half, whichever is longer. Stop too soon or take the wrong amount by mistake, and the IRS tacks on penalties plus interest. Other tools like Roth IRAs, Roth conversion ladders, and even taxable brokerage accounts can bridge the gap before Social Security or pensions kick in as well. Each has unique tax rules to navigate, but if implemented correctly, they can give you a lot of flexibility well before age 59 and a half. The bottom line is this. With smart planning, you can design a retirement timeline that fits your life, not the IRS's default rules. Now that you know when you can access your money, the next question is how to safely use it in retirement. And that takes us to lie number 5. The 4% rule is the best way to use your savings. A rule that's been repeated for decades, but does not always hold up in real life. You've probably heard the basics before. Invest your money, withdraw 4% in year 1, adjust for inflation each year after that, and odds are you won't run out. But the research is outdated, and there are 5 major flaws with this rule. First, It's overly conservative. The 4% rule was built to survive the worst 30-year market scenarios, causing many retirees to underspend and leave behind much larger inheritances than they had intended. In fact, one study showed retirees using the 4% rule were actually 5 times more likely to finish with double their starting wealth than to run out of money. Second, it's inflexible. The 4% rule assumes your spending rises by the exact inflation rate every year. No more, no less. But real life does not work that way. You might spend more in your 60s when you're traveling, then slow down in your 70s, and then ramp up again in your 80s with healthcare costs. A rigid formula cannot adapt to those natural spending rhythms. Third, it ignores taxes and fees. The rule is based on gross portfolio withdrawals, not net. So if you pull $40,000 from a $1 million portfolio, but then incur $10,000 in taxes and investment fees, you're really only living on $30,000. That gap matters, and many people never account for it. Fourth, it assumes one cookie-cutter portfolio, a 50-50 mix of U.S. stocks and bonds. No international stocks, no small caps, no real estate. And it assumes you'll never change your mix throughout retirement. In reality, most retirees adjust allocations as their needs and the markets evolve because life is not a static pie chart. Finally, it's highly vulnerable to sequence risk. Imagine retiring in 2008, pulling $40,000 a year while your portfolio drops 30%. Every withdrawal locks in losses and the math can spiral quickly. According to Morningstar, poor early returns can slash the 4% rule's success rate down to just 60%. That's not the level of confidence that most retirees want. Modern, tax-smart retirement planning recognizes that spending is not a flat line. Markets, tax laws, and your personal needs are always shifting. Rigid rules like 4% forever can be a starting point, but the truth is more powerful. Dynamic, personalized withdrawal strategies often allow you to spend more safely without taking on more risk. Okay, so now you've seen how the most common retirement lies can create fear, confusion, and even missed opportunities. But tearing down myths is only half the battle. The real work is replacing them with a proven, evidence-based strategy. That's where our total retirement system comes in, a step-by-step framework designed to turn complex choices into a coordinated plan. We built it after seeing hundreds of retirees struggle with the same challenges: confusing taxes, fear of running out of money, uncertainty around income, and portfolios that did not match their new reality. What we found is simple. The people who thrive in retirement do not always have the largest portfolios. They have a coordinated process connecting every piece of their financial life. Here's how it works. Step number 1 is tax planning. We intentionally start the process here because taxes touch nearly every decision you'll make in retirement. Withdrawals, Social Security, Medicare premiums, RMDs. Starting here builds the foundation for every other decision. Step 2, retirement income. Using our retirement guardrail strategy, we help you safely maximize income in your go-go years while protecting your future and ensuring you don't run out of money. The goal isn't just more income, it's confidence. Step number 3, legacy planning. Whether it's family, charities, or simply spending with peace in mind, we put a structure around your intentions. Finally, step number 4, investments. Your working years rewarded concentration and growth. Retirement demands balance, protection, and adaptability. No speculation, no market timing, just a disciplined, evidence-based investing strategy aligned with your unique plan. What makes the total retirement system different is that these 4 parts do not work in isolation. They're designed to reinforce one another. Your tax strategy informs your income plan. Your income plan drives your investments. Your legacy goals shape them all. That integration is what turns theory into confidence. So if you're ready to stop guessing and start building a retirement strategy rooted in truth and evidence, click the link below to schedule your free retirement strategy session. We'll walk you through the total retirement system, answer your big questions, and show you how your finances can finally work together to support the retirement you've worked for. Because retirement is not about following someone else's formula. It's about creating yours. And with the right process, you can retire with clarity, confidence, and peace of mind. I'll see you in the next video.